Hello, I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we'll provide a market update for May. We'll start with a recap of returns for April and then shift to an update on the US dollar, the economic landscape, first quarter earnings, and our outlook going forward. The month of April was full of ups and downs for investors as the announcement of sweeping tariffs in early April sent markets into a tailspin. Within days, many of the proposed tariffs were swiftly paused, and after falling nearly 12% during the first week of April, the S&P 500 staged an impressive rebound, finishing the month lower by just 0.7%. Small cap stocks were a bit more challenged, but were able to recover most of their losses for the month as well, finishing lower by 2.3%. International developed markets continued to outperform U.S. stocks, posting positive returns of 4.7% for the month. Emerging market stocks saw positive returns as well, with the MSCI EM index gaining 1.3%. Through the first 4 months of 2025, we continue to see substantial return differentials among various parts of the global markets, with international developed stocks outpacing their U.S. counterparts by more than 16% in total return. In the fixed income markets, falling interest rates so far this year have led to positive returns for taxable investors. After trading as high as 4.65% in mid-February, the yield on the 10-year Treasury note finished the month around 4.23%. Through April month-end, the taxable bond index is higher by about 3.2%. On the other hand, municipal bonds have lagged their taxable counterpart, having fallen about 1% in total return through April. As this next chart shows, we monitor the relative attractiveness of municipal bonds to taxable bonds using municipal to treasury ratios, with the higher recent ratio indicating that municipal bonds are more attractive. We view the year-to-date relative underperformance of municipal bonds as being largely driven by factors such as supply and seasonality, as opposed to fundamentals, and think this is an attractive entry point for municipal bonds. One of the primary drivers behind the recent outperformance of the international markets relative to the U.S. has been the falling value of the U.S. dollar. The dollar index, which measures the value of U.S. dollars versus a basket of 6 other developed market currencies, hit a 3-year low in April. So far this year, the value of the dollar has fallen by about 8%, which provides a direct boost to U.S. investors in foreign stocks and bonds. A generally stronger dollar has been a headwind for international markets over the past several years, but we've seen this trend reverse recently, highlighting the benefits of diversification for investors. Shifting to the economy, April's tariff announcements, followed by subsequent pauses, exemptions, and ongoing negotiations, has left a cloud of uncertainty over the global economy that could persist for some time. As this next chart shows, the first estimate of real GDP growth for the first quarter came in at a negative 0.3%. However, this was primarily due to a surge in imports caused by corporations trying to import as much inventory as possible to try and front-run potential tariffs. This is almost certain to reverse in the quarter ahead. And in fact, if you remove the impact of imports on the quarter, growth would have been meaningfully positive. In addition, the labor market remains on solid ground, and recent measures of inflation continue to move slowly but surely in the right direction, with the Fed's preferred inflation measure, the core PCE price index, higher by 2.6% on an annual basis as of March. Earnings are a bright spot as well, with first quarter earnings on pace to expand by 11% on a year-over-year basis, well above analyst expectations. Revenue growth and margins remain robust, and guidance remains cautious but generally better than expected, an encouraging sign for investors. Looking ahead, we've been encouraged by recent developments on both the policy and economic front during the second half of April. Despite the incredible volatility experienced within the stock and bond markets during the first couple of weeks of April, the market sell-off and subsequent recovery remained orderly. We will continue to monitor developments on the policy front and note that while we don't view a recession as imminent, valuations remain above historical averages and the bar remains high for companies to continue delivering on lofty earnings expectations in an environment ripe with uncertainty. So that's what we have for this month. Thank you for watching and have a great day.